Brad Williams, Frugal Finance. Let's talk about mortgages. How do mortgage lenders calculate monthly payments? Well, just FYI, I owned a mortgage company for 20 some odd years, and I was a broker. The mechanics of fixed rate mortgages is very straightforward. It's balloons and adjustables that can confuse the heck out of people. Now, I owned my mortgage company pre-meltdown of 2008, 2009. I led right up to it. Okay, I was doing business right up to that collapse, and the writing was on the wall. The reason being, about 90%, 95% of my transactions were with Countrywide. And I had a great relationship with the management at the local operation. I did a lot of business through Countrywide. I just asked them, I go, here's a hypothetical. Would you do it? And it was scary. Okay. At the time, if you were breathing, literally, they had no income, no qualifying loans. Literally, you just write your name, you write down your social security number, an address, and if the appraisal supported the loan, they would do the loan, provided that your credit score was good. Didn't have to be great, it just had to be good, which kind of led to the predictable. You can't give away things for free. Now, there's no income, no qualifier loans. Okay, if you price them accordingly. In other words, risk. There's huge risks if you're providing a loan without any assurance that or the loan will ever be paid. With that being said, things have clearly tightened up, and the adjustable rate mortgages back then, and they were freebies. Literally, you could just go in, they'll give you a 1-year sweet deal. And again, you got to keep in mind that home values were just skyrocketing, and then the appraisals were chasing. I don't know if the appraisals were chasing the value or the value was chasing the appraised value. Who knows? It's the egg, the chicken kind of deal. But in the end, it blew up. And it blew up catastrophically. And a lot of it had to do with the adjustable rate mortgage. How do mortgage lenders calculate mortgage payments? One, fixed rate loans. A 30-year fixed loan it's fixed. 6% loan is fixed for 6 years. There's no guessing. You have an amortization schedule, and it's basically you're going to pay, I'm just going to come up with $1,000. You pay $1,000 for 360 months, 30 years. Balloon payments. Now, there's a couple different types of balloons. You have a 5-year due in 30. What does that mean? You have a fixed rate for 5 years. Then you're going to have a readjustment rate at the end of the 5th year, whatever the current rate is. Now, what's tricky here is there could be a little bit of mortgage lenders have cleaned up their act. But in some cases, when you refinance your property or you bought something, you did a 5/30, 5 due in 30, you were under the impression that it would be a fixed rate. There would be an adjustment for a fixed rate for the next 25 years, only to find out that it was an adjustable. And it could be catastrophic. If you do one of these things, and I did, because I never thought when I bought my house that at any means whatsoever, I would stay in a house for 5 years. Well, here I am, nearly 40 years later, and I'm still in the same house, but I started with a 5 due in 30. Was it the right approach? Well, I was in a position where I paid off my house by the time I was 27, and I didn't have to worry about the rollover after the 5th year. But I can't tell you how many clients I had, mortgage clients, where they ran into this snafu and they called me going, look, I got this adjustable, and so I just refinanced them out of that. And then in terms of fixed rate, what you need to know is that there's also the 7-year and the 5-year. In other words, that rate is fixed for 5 years. Let's say it's 6%. Well, it's good for 5 years or 60 months or 72 months if it's 7-year, but then it could higher. If rates have moved higher, then you're going to be subject to that risk. That's the trade-off. The adjustable rate mortgages, there's just way too many to discuss. In the past, they'd have these starter rates at 1%. Then after the 12th month, they would be set to an index. An index would be the current, let's say the 1-year treasury. The 1-year treasury is just a normal government 1-year bond, but it adjusts, and it will adjust whatever the terms of your conditions are. So if there's a reset rate, the 1-year treasury could hypothetically readjust every year. Or if there's a reset somewhere along the line, they could say, we'll index this to the 3-month 1-year treasury. And you're going, what? Yeah, because there are weekly auctions of the 1-year treasury. So what they could look at is every 3 months, look whatever that rate is, and then make an adjustment. Then you can have what are the spread. If rates move higher, you could theoretically, let's say they start you out at 3.5%. And in a low interest rate environment and relative, when I was doing loans, the average rate was 6.5%. Today, people are whining about high interest rates. No, they're at the average. The average mortgage rate or 30-year rate or 10-year rate is about 5.5%. But on mortgages, you usually add 1 3/4 to the 10-year to come up with a 30-year rate. So a 3.5% rate with a 2% margin and an index to the 1-year treasury has a lot of moving parts. The bottom line here, if interest rates increase, your monthly payment's going to increase. If interest rates drop, your mortgage payment is going to drop. It's that risk reward. If you're risk averse, you go the fixed 30 rate. I would always suggest, and I pound the table. I call it forced savings. My clients call me a jerk. Not literally, but I would always press for a 15-year mortgage. Why? Because it will force you to pay that house off sooner. Now, there's going to be a lot of advocates going, no, that doesn't make sense. And I'd say, screw you. I bought my house. I paid it off when I was 27. I have been debt-free for way too many years. And for those youngsters out there who's going, never do that, I'm saying, screw you. You don't know what you're talking about. You don't know the relief of being controlled by a mortgage company, by making a $4,000 a month payment to your mortgage company. Owning a house free and clear is the biggest relief you're going to find in your life. I'm speaking from personal experience. Now, clearly, if you're in your 60s, well, you know you're going to be debt-free. And in the past, they used to have mortgage burning. Oh yeah, they'd burn their mortgage term documents, knowing that relief, that obligation is done. Well, focusing on a 15-year fixed-rate mortgage is forced savings, and it is the best alternative to the 30-year. Adjustable rate mortgage. When I first bought this house, I had an adjustable rate mortgage, and I got scammed by the loan officer and the company. Okay? That's why I got into the mortgage business. So to try to alleviate some of the crap that these people pull. And what happens, and I won't get into that right now, but the bottom line here, you need to understand every term, every word. And I'm being very, very serious here. You walk in, somebody sells you this great mortgage, can get you into a house. You're going, I can own a house and my payments are only going to be $2,100 a month. That's less than rent. That just makes all the sense in the world. They don't tell you everything about the adjustable rate mortgage that got you into the house in the first place and then what's going to happen in 2 to 3 years. No, that was the crisis problem that led up 2005 to 2007 were just obnoxious. Absolutely obnoxious in the different programs that they were offering and the people that got scammed, not knowing the terms and conditions of these horrible negative amortization adjustable rate mortgage. What's a neg am? Well, the interest rate is moving higher and the terms and the conditions say, well, you're only obligated to pay that $2,100, but your actual payment is $3,000. So we're just going to add that $900 a month to your mortgage. So now it's a double-edged sword. In addition to that horrible adjustable rate mortgage, you have this neg am that you're also paying interest on. It's sort of like a credit card on your house. Horrible. And for the most part, those conditions are weaned from a Fannie Mae, Freddie Mac type program. But look, here we are into 2024, and all of a sudden, Wall Street is coming up with these private credit loans. They're horrible. Again, it's a new product, and it's there to screw the consumer, okay? I'm not an advocate of Wall Street at all, at all. So be very careful when you're looking at mortgages. Make sure you understand who's underwriting that loan, what the terms and conditions are. Who cares what that loan officer's telling you? You need to read the information front to back. This information is provided by CFPB. I'm an advocate of government-related information. That's why I provide this stuff. If you have any follow-up questions, comments, the link will be listed below. Watch your back end here. People are there to separate you from your money, trying to bring this to your attention so you're not taken advantage of. Brad Williams, Frugal Finance. Thanks for watching.